Now we're going to look at number 17, and 17 is different because we're not talking about the child tax credit. We're talking about the dependent care credit, right? So that's one of the key differences. So Lenny and Margot spent $2,800 for child care for their 7-year-old son. Lenny's earned income was $41,000. Margot's earned income was $24,800. And the AGI on their joint return was $71,200. It asks us to calculate their dependent care credit. So one thing we want to make sure we take a look at, because this is where I mentioned 2021 is an odd year, or there's some changes here that we normally wouldn't have to consider. And I think this may be even different than what we looked at in the PowerPoint slides for the text, because they found out probably after they saw that part of it in there. So let's look here, because what I did, there's some notes they give us to kind of give us some updates. So this is an update related to the ARPA. So if anybody mentions the ARPA, that's what led to a lot of these changes for at least 2021. So I'll put this document out there. It has how it relates to different chapters and how things could be calculated differently. So in particular here, we're just going to stay focused, and it talks about the child and dependent care tax credit. So for 2021 only, right, meaning until it gets voted to be continued, if it does, eligible expenses are increased. So remember, or before, or if you don't remember, if it's been a normal year, and probably in the textbook, I think it has this. When it talks about dependent care credit, it mentions, here we go, $3,000 if the taxpayer has one dependent, and then you get up to $6,000 if you have two or more. So the limits were $3,000 for one or $6,000 for two or more. And now we're saying in 2021, that gets increased. So if you have one, you can use up to $8,000. If you have two or more, you can count up to $16,000. Right? That's huge increases on both of the sides. The other side is the maximum credit is increased from 35% to 50%. So normally the range would have been from 20% to 35% of the cost up to those limits. And now we're saying the maximum is now going from 35% to 50%. And it mentions here that increase is going to be totally eliminated, or your benefit is going to be moving over the base 20% is going to be eliminated when the AGI goes over $438,000. And that may be important to us, if not on this one, in the next one. So step one, you want to, if you are into phase out, so you look at their AGI. If their AGI is over a certain limit, you're going to start reducing it by 1% for each $2,000 that AGI exceeds $125,000. So that's kind of like what we looked at before in the child tax credit. So you take how much you're over, divide it by the 2,000, and you take 1% of that. Right, but you get 1% reduction for every 2,000, and we'll look at that math. It's not as hard as it sounds. In this step, the credit is reduced to a minimum of 20% for all taxpayers. And then it says, the credit is further reduced from 20% for taxpayers with AGIs in excess of $400,000. The credit is reduced by 1% for each $2,000 that AGI exceeds $400,000. Thus, the credit is completely eliminated when the AGI exceeds $438,000. So again, maybe not for this one, but in the next one, some of those statements there can be important to us. So let's go back over here and see what we can make of it. So one of the things, remember the AGI threshold, we just call it AGIT here, was 125,000. That's when we need to start worrying about reducing it from the maximum percent that they could take. Right? In this case, they're safely below that. So then we need to say, well, how many kids do they have? They have one, right? They have one child. So the limit for one child, remember, got raised to $8,000. However, they only spent $2,800 for care. So they only get the credit based on what they spent, not on what they didn't. In this case, since we didn't go over the limit, we used the maximum, which it just told us had been raised from 35% to 50%. So our credit in this first one, because we didn't hit any of those limits, is going to be $1,400, or C. So let's look at here. It says Mr. and Mrs. Arlett spent $5,900 for their 12-year-old daughter. Mr. Arlett's earned income was $178,000. Mrs. Arlett's income was $33,100. The AGI on the return was $225,200, and it wants us to calculate their dependent care credit. Okay, so let's start looking, and maybe take a second here to go back, because what we're going to run into on these additional notes, we're going to need to do a calculation here related to this step 1. So it says, step 1, the credit is reduced by 1% for each $2,000 or fraction thereof that AGI exceeds $125,000. And it's important to note that it says in this step, the credit is reduced to a minimum of 20% for all taxpayers. Okay, so that's really what's going to hit us in this one. So we're going to look here. It says AGI was $225,200. So first thing, how much or how far are we over the limit? So we're going to reduce it by, or take away the beginning reduction amount of 125,000. When AGI crosses that, that's when you run into the issues. So excess, maybe we'll call this excess. Excess is going to be 225,200 minus 125,000. So what's that? That's $100,200. Okay, so this excess is now divided by 2,000. That gets us to that equation part, and we multiply that because it said for every $2,000 basically that you're over, you get 1% reduction in your credit amount. We had 100,200 divided by 2,000, which is 50.1, so technically I guess you'd round that to 51, multiplied by 0.01. You're going to see it's not going to make a huge difference, because we'll get, what, a 50%, that's our reduction amount. Right, so if we started out, it says the maximum for the year was 50%, and now we're going to reduce it 50%. Right, normally you'd be concerned because that would equal 0% left, except remember it said the minimum, at least in this check, was 20%. So in step 1, you get a minimum of 20%. Then you would only move over to step 2 if the AGI was over 400,000. So let's look at that to verify that. Right, so step 2 is if AGI exceeds 400,000. So we don't hit that limit. So we at least get 20%. That's the minimum. Right, so again, now we need to go back and make sure, right, we said in 2021, the maximum spent would be 8,000. So we do our comparison here and we say, well, 5,900, they spent less than the maximum amount it could be based off of. So we're going to take our $5,900 and we're going to multiply it by 20%. And I think when we do that, we're going to come up with $1,180, or B, that's the amount of dependent care credit that they're going to get. Okay, so now let's look at number 19. Number 19 says, Mr. and Mrs. Bourne spent $1,435 for child care. For their two, right, there's no way they only spent that for two, right, who were 2 and 4 years old. Mr. Bourne's earned income was $55,870. Mrs. Bourne had no earned income, and the AGI on the return was $66,210. calculate their dependent care credit. Okay, and we're going to assume, I think there are some little exceptions out there that state if you're job hunting, maybe you could get some credit. Right, so we need to think here about what I guess, except for the exceptions there, and we're going to assume that doesn't apply. We're not going to think that deep in. But what's the purpose of the credit? What are they trying to do with the credit from the IRS standpoint? And one of the things is, it's really so both individuals can go out and work. Right, so it's a way, if you have expenses that along the way for your dependent care, so the two individuals on the tax return can get income, and especially earned income. So earned income, that means that there's a reason. That's what they want to promote, right? I mean, it's because the IRS wants us, and they know, that we get enjoyment out of our job, right? They know that that we're better people when we can get out and work and feel good about ourselves, right? Yeah, hopefully you see some humor in that, because that may be some of it, but don't be naive. Part of it is they're willing to give you some on the dependent care credit if you're going out and working, because if you're going out and working, you're earning money, you're going to have opportunities to contribute payroll taxes and income tax, right? So there's a reason they're willing to give you a deduction here. So in this case, there's no really calculation to do. Since Mrs. Bourne had no earned income, in their mind, no, you don't get any dependent care credit. Well, unless you want to go and think you qualify for one of those exceptions, but most people don't. The only ones I've read some tax cases where they allowed them some was if, in this case, Mrs. Bourne may not have been working, but she was seeking a job. So there's a certain case that I think they ended up allowing that in tax court. But again, that was not a normal or usual situation. Usual situation is both individuals need to have earned income to get the credit. When one does not have earned income, $0.